Hi and welcome back to the channel. I'm Kristen Struzyna, this is my husband Hans, and today we're going to bring you a Q3 Bay Area real estate market update.
So, as I'm sure you've been reading and watching on YouTube, there's a slowdown happening. Things are changing in our market. We're in a transition period. And so what we're gonna do is digest exactly what we're seeing on the ground, marry it with a bunch of stats that we've done some research on, and then obviously at the end of the video, make sure you stick around for this, give you the advice that we're seeing work today so you can be as successful as possible here in the market. So diving right into the thing that is on top of everybody's minds regarding real estate, and that is interest rates. Obviously, we know interest rates have gone up significantly, and that is affecting a number of things. So let's get into that topic first.
So what we've seen with interest rates over the past year or so is that because there's been so much inflation within the economy, the Fed has been increasing their rate, which then trickles down to the long-term borrowing rates. And so over the past year or so, we've seen interest rates nearly double.
So when you look at the long-term borrowing history and the long-term interest rates for a 30-year fixed mortgage, in the short term, you've seen them double. But when you look at the long-term average, we're actually sitting back at about that number, somewhere in that mid 5% interest rate. So historically speaking, we are right on track with what is considered normal or average. But when you look at the short term, the last year or two, when we were seeing things down in the 2% range, that was historically just unheard of and probably won't happen again, at least in the near future. So in the short term, you're seeing this huge increase, which is obviously affecting the affordability. But in the long term, what we've seen is it's actually pretty stable and pretty typical that you would be in a 5-ish% interest rate.
Speaking of affordability, the interest rate has really affected this affordability. And so if we're looking at some of the numbers and how it has been affected here in the Bay Area, what we're seeing is that households have had to make about $90,000 more in order to afford the same home because of this increase in interest rates. And so this has affected households and families on a pretty large level. If we're looking at mortgage payments, so that's principal, interest, taxes, and insurance, what we're seeing is that that number is 36% higher over the last year. So in Q2 of 2021, that PITI number was about 5,200. And in Q2 of 2022 of this year, that number for the same median home is right about 8,300. So that's a significant increase for a lot of families and a lot of households as they consider purchasing a home.
And when you look at it relative to national averages, California is always below the national average for affordability, but we are darn close to, at the state level, the levels that led up to the 07-08 crash. We're seeing about a 16% affordability rate, which means 16% of households in California can afford the median priced home based on these numbers that we were just quoting. The Bay Area is obviously broken up county by county, but is on average consistent with that number. And so because those mortgage rates have increased and prices haven't yet come down in lockstep, what you're seeing is the number of people who can actually afford the house has just simply shrunk.
And while we know this all sounds like doom and gloom, do make sure to stay to the end so that you can hear what we're telling our clients who are both on the buy side and on the sell side. Okay, so back to payments and how this is affecting families. So we're seeing that mortgage payments have gone up, and what we're also seeing is that people are feeling squeezed in other areas. We've seen gas prices having gone up, food prices gone up, and generally inflation is raising prices across the board. And so as a result, people are spending their discretionary income on more of the essentials rather than the non-essentials. So things like food, shelter, rather than things like vacations and cars.
And so what you used to be able to buy even just a year ago with that same income, you just don't have that discretionary income. So people are feeling relatively poorer, even though wages are technically up because unemployment's very low and the job market is very strong, relatively speaking. But that consumer confidence piece has gone down because people aren't feeling the positive effects of making more money because their money just doesn't buy as much, simply. And so you are seeing, even though long-term borrowing rates are on average, they're kind of on that middle line. Equity's very high, the banking system's in a good place, unemployment's very low, obviously. You're seeing this consumer confidence trickle down, and folks are just simply not as confident to make these big purchases, whether it be a car, a TV, or definitely a home. But the flip side of this is you would expect that when consumers take themselves out of the market, borrowing costs go up, that prices would come down. It's supply and demand, right? But what we've seen is while price growth has started to decelerate, it is still positive. We're seeing very minimal price growth, and depending on the price point you're talking about, we're seeing it really level off or grow very subtly, 1%, 2%, 3% quarterly, as opposed to 10, 15, 20% a month that we were seeing even just earlier this year. And so what you attribute that to is supply and demand, and specifically the supply side.
And so what we're seeing is that homes are still statewide selling 46% over their list price, but overall it's felt like a healthy slowdown.
And if you look historically speaking, we're back to sort of that pre-pandemic level at a state level, and simply the party that was the last 2 years in the real estate market is over. We're experiencing more normal levels on a macro historic level than we were in the last 2 years. If you look at really any graph of prices, price appreciation, unit count growth, any of that kind of thing, the last 24 months has been frankly an anomaly, and more or less we are kind of on the backside of that curve, heading back into what feels like a more average market, at least in the short term, and then we'll see what happens long term.
And what we're seeing as far as our experience working with buyers and sellers is that there's a little bit more sanity in this whole process. There's not the bidding and overbidding that we were seeing earlier this spring. People aren't clamoring to grab homes like we were seeing. And just generally speaking, buyers have a little bit more time through this process. They can digest all of the information. It's not to say that they're getting screaming deals on homes, but it feels like everything has come back to a more sane level.
I would even venture to say that it feels fair. Almost all the buyers that we've helped buy a house in the last 90 days have gotten what we feel like is very fair deals relative to the comps. Not only are the prices they're paying fair, but the terms they're getting, potentially negotiating something with the seller to buy down the rate or to get a credit for something. It's back to a more sane level rather than the blind bid. You got to go 10, 15, 20% over the comps and cross your fingers that it appraises. Those days feel like they're gone, at least for now, and we are moving back into a longer days on market and less bidders, and thus less of an intense negotiation that's all based on just throwing money at the problem.
And speaking of the pace of the market, a lot of what we're hearing is that people are feeling like the market has slowed down a lot. But if we look into the data around days on market for homes that are selling, so the day they hit the market until the day they go into escrow, we're seeing that from 1 year ago to today, what we're seeing is that from July 2021, the median days on market was 8 days, so very quick. But in July 2022, that number is still only up to 14 days. So homes are still turning over relatively quickly, even though it feels like things have slowed down significantly.
And the headline there is obviously days on market doubles, but when you zoom out for a second and you look at the historical data, again, you see that it's still relatively low, and 2 weeks to have a house on the market is still incredibly fast by state or national standards. But in general, it is just, again, coming back to this like median line, this slowdown back to the center, if you will. But the flip side of that is what you're seeing is for the last 4.5 years, we've seen the number of listings consistently ticked down. So the units, the turnover of existing home sales has decreased, and we're expecting to see a significantly lower number of units sell this year than last year and the year before and so forth. And so even though the buyer pool is starting to shrink, the new listings showing up are also shrinking. That joined with the fact that new construction starts are down, and we're in this very deep valley, which we've talked about on so many other videos, of new construction, and builders are just not building, which is a different topic for another day. So the supply side is just not there to meet what is still a fairly reasonable demand, and so you're still seeing this imbalance in general. On the ground, what we're seeing is instead of getting 10, 15, 20 offers, you're somewhere between 0 to maybe 5. That's not to say that houses aren't getting 10 plus offers. Occasionally you do run into that. If there's a really great location, something that's got an ADU, something with a view, just the house of the week, if you will, those ones are still attracting a lot of the attention. But almost everything else is getting much less attention, much fewer offers, and ultimately selling for more or less what the comps suggest, plus or minus a few percent.
So that leads us into the advice that we're giving our buyers and sellers that we're working with right now. So let's start on the seller side of things. What we're seeing on that side is that it really pays to be the house of the week, if you will. So what that means is the staging, the photography, the marketing, the presentation of the home, the pricing of the home. These factors all come together and need to be so dialed in that when buyers are out there browsing for homes, when they see your home, they stop and they spend a little bit more time. They browse through the photos enough that they want to then come into the open house, take a look. And what we're seeing is that open houses, even though we felt like the market took a big breather in June when gas prices were high and a lot of people were traveling, people are starting to come back to the table now. And so open houses are a little better attended. We're seeing buyers with better questions and more interest in homes. So if you are the home of the week, that means that you're generating that interest and getting more people through the door to then potentially dig deeper into the property and write an offer.
The key is, if you're going to sell your home, do everything you can to get someone to the table. Even if they start low, you can work on a negotiation. I would in fact expect you to work on a negotiation instead of just having 5 non-contingent offers that are just jumping over one another. Now, if you're looking to buy, this is the opportunity that you've been waiting for. This is the first time that you've had the ability to negotiate and to show up with maybe a slightly lower offer with some decent terms that kind of favor you a little bit, favor the seller a little bit on one or the other, and give you that opportunity to get into the house and not an excruciatingly high number dollar-wise. So the advice that we're giving is really simple. We talked about interest rates at the beginning. They're up. We all know that. Don't necessarily focus on the interest rate by itself. Focus on the home. We're saying marry the house, date the rate. Because if what you believe is we're going into a recessionary period, historically speaking, rates come down during recessions. That's how they get the gears of the economy going again, is to decrease borrowing rates. And so if you are willing to be a little bit more strategic, have a different negotiation, talk to your lender about 7 or 10 year or even 5-year ARM products, a 2-1 buy down, get the seller to potentially give you a credit to buy down your interest rate so that your payment is lower. There are some really wonderful opportunities out there to do that. The other thing to keep in mind is right now jumbo loans are in general pricing better than conforming. And so this might be an opportunity for you to get into a jumbo price point, potentially even buy down the rate or do something creative there and get you into a better house than you would have been able to afford 6 or 12 months ago. And so if the right house comes along, don't let it pass you by, because there are a lot of houses that are collecting days on market where there's nothing wrong with them. They're just being overlooked by the market, broadly speaking. So show up, marry the house, date the rate, and look for a creative financing strategy that will help you get into the house today so that you can then live in it and start your life and so forth. And then you can worry about kind of the next step as the next chapter of this market change unfolds.
Thank you so much for being here and watching all the way to the end. If you liked what you heard, make sure you like and subscribe, and we look forward to seeing you on the next one.